Welcome to the HMO Property Show. By investors, for investors. Catch us weekly as we discuss all things cash flow positive property investing. Whether you're a seasoned investor, a new landlord, or just curious about property investing, this is the podcast for you. Sponsored by the Co-Living Collective, your trusted partner in creating vibrant and sustainable shared living experiences. Visit us at colivingcollective.com.au to learn more.
Welcome back to the HMO Property Show. I'm your host, as always, Neil Gibb, and today, following up off the back of last week's episode about the RBA cash rate decreasing and people now having more borrowing capacity and able to access equity, I thought I'd record you an episode on equity and how to access that equity and things to consider, like how to release it, why, when you release it, it becomes tax deductible, and how investors use it to buy more properties. And if you remember, like the game of a lot of other sort of property investment companies is just buy in high growth areas and leverage into the next deal, and then that deal is in a high growth area, then leverage into the next deal and leverage. Well, all that does is keep getting you heaps and heaps of debt, which is good. We need debt to build property portfolios and we need growth to accelerate the journey. But you also want to be in a position where you can actually decrease that debt as well, right? So firstly, what is equity? Equity is just a fancy word for the difference between what your house is worth and what you owe the bank. Simple, right? So if you've got a property that's worth $900,000, and you owe $400,000 on your mortgage, then you got $500,000 in equity. So that's a very typical sort of scenario with a lot of investors that we speak with. But here's the problem, that full $500,000 is not all accessible. So it doesn't mean you've got $500,000 to go out there and spend on another property, because the banks will only usually let you borrow up to 80% of the property value. They might let you borrow 90, but for this example, I'm going to talk about 80 because we tend to stay away from the 90% LVR range. So 80% of 900k is 720,000. You owe the bank $400,000 on your old property, which means you can access $320,000 of equity. This is called a cash out refinance, and this is what people do to build property portfolios. Now you can pull equity out of your principal place of residence. So if the house that you live in has gone up in value, then you've potentially got equity that you can access. You're not actually selling the property, right? You're just using the increase in value to pull it out and move into another property. Now, you don't get taxed on that profit because you're not selling the property. You are just accessing more debt, right? And because it's gone up in value, you've built the equity, and as long as you can show that you can afford the new loan repayments, they're happy to lend against that new increased value. That's the kicker, right? As long as you can prove that you can afford the new loan repayments. And because of high interest rates, this has stopped a lot of people from moving forward. It's stopped a lot of people moving forward because they don't have the disposable income to allocate towards that increase in difference. And the banks want to make sure they get the money back, right? So they like to make sure that they've got a buffer there and that you've got enough cash to pay them back if they do give you it. So how do you actually access that equity, and how do you understand what it actually is? Firstly, you need to speak to your broker, or if you don't want to use a broker, like some people don't, I think you're kicking yourself there to be honest, but a lot of people want to go direct to the bank. Then what you do, you go to your broker and you'd say, hello, Mr. or Mrs. Mortgage Broker, I would like to get my house refinanced and pull some cash out of it. And depending on what that property is, depending on what sort of value they will get. If you are dealing in the standard residential space and you're dealing with the Commonwealth, the Westpacks and the NABs, etc., then you won't have to pay for that valuation. However, if you're working in the HMO space, if you're not aware, even though it's a residential lending package, we use a commercial valuation to give the property its true value. And the real reason for that is because when you compare a 6-bedroom, 6-bathroom compared to a 4-bedroom, 2-bathroom, there's a total difference in price, right? So we can't use comparable sales in that area and say, well, what have other 6-bedroom houses sold for? Because not many have actually sold. And the kind of closest comparable to the 6x6 is a 4x2 or a 5x3 potentially, and that's going to sell for a lot less than a HMO would, because the HMOs cost more to build and rent out for a lot more. So the mortgage broker will get the valuer brought in. If you're going down the HMO commercial route, you have to pay $3,000 to $3,500 for that valuation to be assessed and issued, and then you can go to the bank and you can pull that money out of the property, and guess what, it actually gets deposited into your bank account. Now this is where you can potentially stuff it up, right? Please don't go on a holiday, please don't go buy a car, please invest it in a new investment property, because when you release equity specifically from your principal place of residence, you're not earning profit, you're borrowing more money, and it's a loan, it's not profit. This is why you don't pay tax on it. And if you use that borrowed money, that increase in borrowed money, to invest in something that generates an income or buy another property just for any sake, then the interest you pay on that loan can become tax deductible. Speak to a good accountant. This is where your A team comes in to play. You need a good accountant, a good lawyer, a good broker. You're borrowing money for a business purpose. You're treating your property investing like a business. That's the way the ATO sees it. It's not for personal use. And if you do pull that money out and you do buy a car, or you do pull that money out and you do go on holiday, then you're going to break that rule, and it's not going to be seen as used for a business purpose, and it's not going to be tax deductible. So if the purpose of the loan is to make more money, then the interest becomes a deductible expense against that income. And when you're not paying tax when you pull the equity out, and when you use it wisely, the loan interest can reduce how much tax you pay on your future earnings. Which means when you release the equity and use that borrowed money to invest, the interest on that tax, on that debt, becomes tax deductible, because it's not on your house, but because it's tied to an income producing asset, right? And if the property is negatively geared, that is, the rental income is less than the expenses, let's not go down that path, you can still benefit from that tax deduction, right? And this is why a lot of people invest and say, oh, you can claim it back on tax and blah, blah, blah. Well, what if you're positively geared and you can still claim that tax deduction, right? And I'll get into that in a second, because I don't want to jump the gun. Why can you get it as a tax deduction? Because the ATO allows you to deduct the losses from income producing assets against your other taxable income. And if you're running a shortfall on paper, that loss can then help reduce the amount of tax you owe elsewhere. It's not just about profit, it's about the purpose and structure. The purpose of the loan determines the tax outcome. So if you've used the money, or the funds, should we say, to buy an investment property, to renovate a rental, to invest in a HMO, then it's probably going to be tax deductible. Again, you need to speak to a good accountant who understands this stuff. But if you use the funds for personal use, like buying a new car, going on holiday, or even doing the kitchen in your own principal place of residence, then that interest is not tax deductible. And the ATO draw a very hard line here, right? So if the loan isn't used to generate income, you can't claim it as a tax deduction. And to be honest, accountant probably shouldn't let you do that anyway. So always ask yourself, is it going to generate income? And if the answer is no, it's probably not deductible. Then the interest on that portion of the loan is tax deductible. So let's walk through an example. Let's say you bought your house for $500,000 with a 20% deposit. So that's a $100K deposit and a $400,000 loan. Now, a few years later, that home is worth $950,000. It's a very typical scenario for a lot of people all across the country right now, especially in the last 3 to 5 years. 80% of 950 is 760,000, and you still $400,000 on your original loan. So that means you could release up to $360,000 in equity. Let's say you choose to pull out $300,000 and invest it into a HMO. Because that $300,000 is being used to purchase an income generating investment, the interest on it becomes tax deductible. This means the money you pay the bank in interest can be claimed back at tax time. So if you're in the 30% tax bracket and you pay $10,000 in interest on the loan this year, you could get $3,000 back from the tax office. It's like the government giving you a discount for using the money to build your financial future, right? Actually having the ATO as your business partner. And then it also means that you're turning lazy home equity into high-performing, tax-efficient investment vehicle, and you're using the bank's money to do it. And I'm not going to go down the rabbit hole of it's not even the bank's money. It's just a whole fugazi, right? It's not even real money that they lend us. They lend out money that's not even theirs and then call it debt and charge you money on money that's not even theirs to lend out in the first place. Don't get me started. So if we go one level deeper for those who are investing in a trust, and a lot of our clients invest through specific special purpose vehicles, and the most common one that we see being set from them for our accountancy team is a discretionary trust with a corporate trustee. So, and again, if you release equity from your own home, your principal place of residence, and you borrow $300,000 from that home loan, then you lend that money to the trust via properly documented loan agreement. Then the trust uses that money to buy a HMO and generates rental income. Because the funds were used for an income producing purpose, the interest on the $300,000 is tax deductible to you personally, not inside the trust. So if you're paying $15,000 interest annually on that loan and you're in the 30% tax bracket, that's up to $4,500 you can claim back on your personal tax return. And the important distinction is, let's say the HMO generates $20,000 of net cash flow after all expenses. It's received by the trust, and the trust pays no tax directly because a trust is essentially a pass-through vehicle. You don't want your money to be left in the trust. You want to distribute at your discretion, which is why it's called a discretionary trust, to someone in a lower tax bracket. And if it's distributed to beneficiaries or family members, they will be taxed at their personal marginal rate, right? Whatever it is now. Keeps changing, doesn't it? 30%, 32%, 38%, 45%, whatever that is, it gets added onto their personal income. And that tax deduction for the interest stays with you personally because the debt is in your name. So you claim the tax deduction against yourself. You could then potentially pay that profit to yourself, and the profit could be offset by the income. The profit could be offset by the deduction on the tax that you've drawn down from your personal loan. So you can use the tax deduction on your personal income to help offset the profit being distributed from you to you from the trust. This is why the structures are so important, right? And this is why you want to work with strategic people, mortgage brokers, accountants who understand how to set you up in the right way. Set yourself up like a business, treat this like a business because it is a business. It's going to generate a lot of income for you on a almost automated sort of system. How do we use the equity to buy a HMO, for instance, and use the income to pay off debt faster? So if we're all big about paying off debt so that you can build wealth twice as fast as everybody else. Excuse me. So you pull $300,000 out of your principal place of residence, you buy a home, you buy a HMO that generates a 10% gross yield. It covers all of your costs and it gives you $20,000 a year net cash flow. Typical scenario, especially the way interest rates are going right now. And then you get the tax deduction on the interest you use to buy it. So you're using the bank's money. Then you're using your tenants to pay down the loan on your principal place of residence, and the tax department actually chip in and help you with that as well in the terms of tax deductions. And then recently I had a client saying, well, did the profit that we make inside the trust, do we not have to pay tax on that? Yes, you do. But again, with the right sort of setup, the right structures, and using something called a depreciation schedule, that you can actually reduce that tax and keep more of the cash flow working for you. So let me just say everything in this is for information only, and it's for me to help you understand some of the things that you can speak to your accountant about. I'm not an accountant, I'm not a mortgage broker. I'm just a guy that's got a property portfolio and help hundreds of people generate wealth through investing in HMOs as well. So I am not the expert. I am surrounded by experts, and I am knee-deep in this all day, every day. So I'll give you a bit of an example. Let's say we build a 6-bedroom HMO for 1.2 mil. Each room rents out for $375 a week. That's $2,250, or about $117,000 a year in gross rental income. Then if you take away your expenses like your property management, your rate, your insurance, your utilities, your maintenance and your mortgage, you probably end up with around $15,000 a year net cash flow after all expenses. Now we've got some BMT tax depreciation schedules from BMT, obviously. You don't have to use BMT, you can use any depreciation company. There's plenty of them out there. And the first year depreciation on a 6-bedroom, 6-bathroom, double-storey HMO is around the $40,000 mark. So even though you have $15,000 profit in your pocket, on paper your trust shows a loss of $26,000. That means that you pay zero tax on the $15,000 of cash flow. And you can use every single dollar of that to pay down the mortgage faster. Plus, the remaining payable loss can potentially offset future profits as well. So when you think about it, positive cash flow and negative taxable income, kind of like the sweet spot of investing, right? Yeah, everyone else is negative cash flow and trying to claim back their losses. I think this is just a much better way of doing it, right? So in the trust, you can deduct management fees, cleaning, utilities, council rates, accounting and legal fees, and the loan interest if the trust borrowed funds too, which 9 times out of 10 it does. And then you can use the trust's flexibility to distribute income to lower income family members or to a bucket company, which is generally taxed at 30%. Or you can use your depreciation schedule to pay no tax, zero tax, and pay down the debt faster. So you do pay tax, yes, but smart investors with the right setup and the right documentation can minimize that tax so they can accelerate debt reduction and build wealth faster. But again, you need to get personalized tax advice from a licensed accountant. Make sure that your structure is working hard for you, making sure your money is working hard for you so you don't have to work hard for money. There is I hate it when people say just work smarter, not harder. There's an element of graft that needs to be done to get you in the position where you can not have to work smart. So you've got to work hard enough to not have to work hard again. I've worked my ass off for 10 years to get myself in the position that I'm in, and anybody else can do what I've done. All I've done is took risk, worked hard. I've been knocked down many, many times, and I've got back up and I've kept on going. So I've seen people with 500,000, like the position I'm in, right? And the people I speak to and the portfolios I see and the positions of people that I see blows me away that they sit on so much lazy cash within these properties. People wear it like a badge of honor and say, I'm debt free. My property is debt free. I'm like, cool. How many investment properties have you got? None. Okay. So I've seen people sit on $700,000 of equity with no debt against the property, and I've seen others with 250k and turn it into $100,000 a year in passive income in like 5 to 7 years. Easily done, but you've got to work hard, right? You've got to do these things. You've got to get out there and take action. So you can choose which one you want to do. From here, you can, if you're sitting on a property that's gone up in value, or you've got a property portfolio that's gone up in value, you can get your home revalued, speak to a broker. If you want to speak to our team, let me know. And we would love to help you, because what's happened in terms of interest rates going up and people struggling with borrowing capacity and serviceability, this will happen again. History always repeats itself. Like, will we have another pandemic? Who knows? I don't think so, but you never know. But will interest rates go up again? Will that lower your borrowing capacity? Will that affect your lifestyle? Potentially. So whilst interest rates go down, don't get carried away and start buying a load of negatively geared, high growth investment properties again. Use the equity that you've produced during this last run and start moving it strategically into cash flow producing assets. Now, if you do commercial instead of HMO, great. I just want you to have income producing assets, because equity doesn't build wealth. What you do with that equity builds wealth. Now, if you access your wealth in the way of two ways, you can either sell your property to access that equity, or you can refinance that equity to buy more properties. But essentially, everybody builds a property portfolio so that they've got enough equity, so that equity produces income for people to live off. It's like I said it before, I think my team is sick of hearing this, but the golden goose that lays golden eggs. Equity is the golden goose, but if you slay the golden goose, then you're not going to get any more golden eggs. But you're going to feast off the equity, right? Once that feast is gone, it's gone. If you've got a golden goose that lays golden eggs, you can live off them golden eggs. And the golden goose will keep laying them eggs, and that's what a cash flow producing asset is. A golden goose that lays eggs. So there you go. That's how you release equity, and hope that helped with the tax deduction part, understanding that, yes, your holding costs are going to increase on your principal place of residence if you do access that equity. However, you can make it a tax deduction. You can invest it into an asset which has also got lots and lots of tax deductions attached to it. You can minimize your tax payable on the profit that you make, and you can accelerate your wealth journey faster and more smarter. So remember, every master was once a disaster, and every winner was once a beginner. See you next week.
Welcome to the HMO Property Show. By investors, for investors. Catch us weekly as we discuss all things cash flow positive property investing.